Most people think a savings account is an asset, but in 2026, it has officially become your biggest financial liability. When you park your money in a traditional bank, you are essentially lending it to an institution that uses it to generate massive profits while giving you back a fraction of a percent. For example, while your bank might pay you 4% interest, they are lending that same capital out for mortgages or business loans at 8 or 9%. You are bearing the risk of currency devaluation while the bank reaps the rewards of leverage. By keeping the majority of your wealth in cash, you are effectively paying a holding fee in the form of lost purchasing power. It is time to stop viewing your bank balance as a measure of wealth and start seeing it as a decaying storage unit for value. Success in the modern economy requires moving from a saver mindset to an owner mindset. The economic landscape of 2026 has fundamentally shifted due to the normalization of higher structural inflation and digital currency transitions. Central banks around the globe have pivoted toward policies that prioritize debt management over currency stability, which means your cash loses value faster than ever before. Consider how the cost of essential services like healthcare and education has outpaced official inflation metrics for years. If you held $100,000 in a standard savings account over the last decade, your ability to buy these services has likely dropped by nearly 30%. This shift means that holding cash is no longer a neutral position, but a losing bet against the global economy. Understanding that the rules of the game have changed is the first step toward protecting your financial future from silent erosion. You must adapt your strategy to account for a world where cash acts as a melting ice cube. Inflation acts as a hidden tax that specifically targets those who hold the most cash. It is a mechanism that transfers wealth from savers to borrowers by devaluing the currency used to pay back debts. Think about a person who saved $50,000 for a house deposit 5 years ago and kept it in a high-yield account. Even with interest, they now find that the same house costs 60% more, effectively pricing them out of the market despite their disciplined saving habits. This proves that your savings account is actually a liability because it fails to preserve your purchasing power against a rising cost of living. To build real wealth, you must move away from nominal gains and focus on real returns after adjusting for inflation. Protecting your capital means putting it into assets that rise alongside or faster than the general price level. Every dollar sitting in a savings account represents an opportunity cost that compounds over time. When you choose the perceived safety of a bank, you are actively choosing to forego the growth potential of productive assets like equities or real estate. Imagine two investors, where one puts $10,000 in a savings account and the other invests in a broad market index fund. Over 20 years, the saver might have $15,000 while the investor could easily have over $40,000. This gap is not just a missed profit, but a direct loss of future freedom and security. Your savings account is a liability because it locks you into a trajectory of stagnation while the rest of the world builds equity. Realizing the cost of inaction is vital for any modern financial strategy. You cannot afford to let your capital sit idle in a rapidly advancing world. The yield gap between what banks earn and what they pay you is currently at an all-time high. Banks are in the business of arbitrage, taking your low-cost deposits and putting them to work in high-interest environments. If you look at the quarterly earnings of major financial institutions, you will see record net interest margins derived from the spread between their lending rates and your savings rate. This means your hard-earned money is the fuel for the profit machines of the bank while you receive a pittance in return. This disparity proves that your savings account is a tool for the prosperity of the bank rather than your own. To fix this, you need to find ways to capture that yield for yourself by cutting out the middleman. Moving your capital into direct investments allows you to keep the full return instead of letting a bank skim the majority of the profit. High-yield savings accounts are often marketed as a golden ticket for conservative investors, but they are frequently a psychological trap. These accounts offer a slightly better return that still fails to beat the true cost of living increases when you factor in taxes and real-world inflation. For example, if you earn 5% interest, but your marginal tax rate is 30% and inflation is 4%, your real return is actually negative. You are working harder to save more money just to stay in the same place or slowly fall behind. This false sense of security prevents many people from seeking out the higher returns necessary for a comfortable retirement. Recognizing that high yield is often a relative term rather than an absolute benefit is crucial for your 2026 strategy. You must look beyond the advertised rate to see the true impact on your wealth over time. One of the most overlooked reasons why savings accounts are liabilities is the heavy tax burden on interest income. Most jurisdictions tax interest at the highest marginal rate, meaning the government takes a significant portion of your already low returns. Compare this to long-term capital gains on investments, which are often taxed at a much lower rate, or can be deferred for decades. If you earn $1,000 in interest, you might only keep $700 after taxes, whereas $1,000 in stock growth remains untaxed until you sell. This tax drag significantly reduces the compounding power of your savings over the long term. By focusing on tax-efficient growth instead of taxable interest, you can keep a much larger share of your wealth. Minimizing your tax liability is just as important as maximizing your returns in a modern financial plan. Tax strategy is a pillar of wealth creation. The traditional advice to keep 6 to 12 months of cash in a savings account is becoming an outdated and expensive strategy. While liquidity is important, overfunding your emergency account leads to massive lost growth over a lifetime. For example, keeping $50,000 in cash for an emergency that might never happen could cost you hundreds of thousands in potential gains over 30 years. A better 2026 approach is to keep a smaller cash buffer and use credit lines or highly liquid brokerage accounts for true emergencies. This allows more of your capital to remain invested and productive while still providing a safety net when needed. Right-sizing your liquidity ensures that you are prepared for the unexpected without sacrificing your long-term goals. Efficiency in your cash management is a hallmark of a high-end financial strategy that prioritizes growth over comfort. The desire for the safety of a savings account is often driven by a psychological fear of market volatility. However, this perceived safety is an illusion because the certain loss of purchasing power through inflation is a greater risk than the temporary fluctuations of the market. People who stayed in cash during market recoveries have historically missed out on the largest periods of wealth creation in human history. To overcome this, you must shift your mindset from avoiding short-term loss to ensuring long-term gain. Understanding that volatility is the price of admission for growth helps you stay disciplined during uncertain times. Your savings account feels safe because it does not show red numbers, but the damage is happening silently every single day. Embracing calculated risk is the only way to secure a prosperous future in 2026. Financial peace comes from owning assets, not holding cash. Moving away from a savings-heavy strategy requires a systematic transition into productive assets that can outpace the economy. You do not need to move all your money at once, but you should have a clear plan to reduce your cash position over time. For instance, using dollar-cost averaging to move funds into index funds or real estate investment trusts can mitigate the risk of market timing. This process turns your idle liability into a working asset that generates its own income and growth. As your asset base grows, the need for a large savings account diminishes because your investments provide their own liquidity and security. Taking the first step to redeploy your capital is the most important move you can make this year. Success in 2026 is defined by how well you put your money to work rather than how much you store. In 2026, the concept of wealth preservation must include an active defense against the devaluation of traditional currencies. Holding cash in a bank means you are tied to the stability and policy decisions of a single government and its central bank. For example, when a country decides to increase the money supply to stimulate the economy, the value of every dollar you have saved is diluted. This global trend toward currency debasement makes your savings account a liability because it lacks the scarcity or utility of hard assets. Diversifying into gold, Bitcoin, or international equities provides a hedge against these local economic shifts. By spreading your wealth across different asset classes, you reduce your exposure to any single point of failure. Protecting your net worth requires a global perspective and a move away from total reliance on cash. Modern wealth is built on a foundation of diverse and resilient assets. To wrap up, we have seen why the traditional savings account has transformed from a safe haven into a financial liability that erodes your wealth. We explored how inflation, taxes, and opportunity costs work against you while the banks profit from your deposits. By shifting your perspective and treating cash as a strategic tool rather than a long-term storage, you can take advantage of the growth opportunities available in the economy of today. Remember to review your liquidity needs and consider moving toward a more diversified, asset-backed portfolio. If you found this deep dive into 2026 financial strategy helpful, please like the video and subscribe to the channel for more high-end education. We want to hear from you, so please leave a comment below telling us what percentage of your net worth you currently keep in cash. Thank you for watching, and we will see you in the next video.